Ladies and gentlemen, good day and welcome to the Q1 FY2025 results conference call of the Phoenix Mills Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Management of the company is being represented by Mr. Shishir Shrivastava, Managing Director, Mr. Kailash Gupta, Group CFO, and Mr. Varun Parwal, Group President, Strategy, Audit and Head, Corporate Finance. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touch-tone phone. Please note that this conference is being recorded. At this time, I would like to hand the conference over to Mr. Shishir Shrivastava. Thank you, and over to you, sir.
Good afternoon, ladies and gentlemen. My colleagues and I take pleasure in welcoming you all to discuss the operating and financial performance for Q1 of FY25. I will now take you through the key highlights of the results with reference to the relevant slides of the results presentation. Slide 3 is a brief financial overview. Consolidated income from operations for the quarter grew by 12% year-on-year to 904 crore. Operating EBITDA was up 8% year-on-year to 531 crore. Operating EBITDA excluding the residential business for Q1 FY25 is rupees 525 crore, up 21% year-on-year. Profit after tax increased 10% year-on-year to rupees 295 crore. Turning to our retail business, covered from slide 4 through slide 13. I may draw your attention to slide 5. Consumption across all our malls during the quarter grew by 25% to rupees 3,215 crore. Like-to-like consumption, excluding the new malls which weren't operating last year at the same period, which are Phoenix Mall of the Millennium and Phoenix Mall of Asia, Bangalore. Excluding these malls, like-to-like consumption grew by 7%. Consumption growth across the portfolio was led by strong double-digit growth in Phoenix Market City, Kurla, Mumbai, and Phoenix Palacio, Lucknow, and an impressive ramp-up of occupancy consumption in the 4 new assets which were launched last year. Year-on-year growth in like-to-like competitive malls was impacted due to multiple factors. During the election, several of our malls were shut for most part of the day on voting days, plus restrictions on restaurants serving alcoholic beverages, which had an impact of between 4 to 7 days for each mall in each city. Fewer number of movies and lack of blockbuster movie content impacted the multiplex performance and advertently some footfalls in the mall. The summer was quite difficult in many parts of the country, and the heat wave in lesser footfalls resulted in lesser footfalls, but improvement in four-wheeler traffic. Moving on to the category mix in consumption, on a like-to-like basis, we saw a 22% growth in the jewelry category, which may see further boost post the GST rate cut in the recent budget, and 19% growth in gourmet and hypermarkets. FEC and multiplex posted a degrowth of 4%, while fashion and accessories and the F&B category grew by single digits. Positively, the consumption in electronics has increased in this quarter compared to last year, which is a reversal of trend we have seen in FY24. Moving on to occupancy, the weighted average trading occupancy across major malls in the portfolio improved from 88% in March 2024 to 90% in June 2024. PVR at Palladium Ahmedabad will be launching tomorrow, taking the occupancy to 90%. Retail rentals and EBITDA. Our retail rental income for the quarter was at rupees 487 crore, up by 31% over Q1 FY24. This was driven by strong performances from Phoenix Market City in Mumbai and Phoenix Palacio, Lucknow, and the ramp-up in the new malls. The strong rental income growth translated into a 31% year-on-year increase in retail EBITDA, leading to a retail EBITDA of 516 crore for the quarter. EBITDA margin for operational assets remains healthy at 107%. New malls contributed approximately 85 crore in rental income and 86 crore in EBITDA. EBITDA margin is slightly lower at 100% in new malls during the initial period of occupancy ramp-up. Our outlook going forward, we continue to focus on retail rental and EBITDA growth. While like-to-like consumption growth for the quarter was 7%, the retail EBITDA growth was 10%. Especially in our older assets like Phoenix Market City malls located in Bangalore and Pune, the focus is currently on premiumization through enhanced retail mix and category improvements, creating a compelling entertainment and F&B destination, keeping the brand mix fresh by introducing new brands across different formats, a focus on creating specialized clusters to enhance shopping experiences, developing high recall and creating high engagement through live performances, unique curated events, larger-than-life decor and art installations. Asset enhancements through facade upgrades, change in layout, and working to minimize or maximize customer convenience by redesigning the traffic circulation is also high on our priorities. In fact, we've already carried out the first phase of this revamp at Phoenix Market City, Mumbai. Results are visible to a significant extent, with the center reporting a 12% growth consumption and a 15% increase in EBITDA. And we are confident that this growth will sustain in the coming quarters with more asset enhancements, retail category cluster creation, and high recall marketing events. Moving on to the commercial office business covered from slides 14 to 17. Our operational portfolio in Mumbai and Pune delivered a growth of 20% in total income and 33% in EBITDA due to an improved occupancy of more than 70%. We leased approximately 1.5 lakh square feet during the quarter. Occupancy in our operational portfolio climbed to 71% by June 2024 and from 70% as of March 2024, while maintaining a healthy gross rental level at approximately 114 rupees per square foot. We look forward to the launch of new age commercial office spaces in Bangalore, Pune, and Chennai, which have generated significant interest. As the demand for space is increasing, we are striving to strike a balance between the occupancy rates and the rental rates with a long-term view. But we are certainly seeing a resurgence in demand for grade A commercial office spaces which are that we have in our portfolio. Moving on to the hospitality portfolio covered from slides 18 through 22. The St. Regis Mumbai, our marquee asset, maintained a steady room rate of approximately 16,400, with the occupancy increasing to 85% in Q1 FY25. The improved occupancy led to a 3% increase in room revenue compared to the previous year. F&B and banqueting revenue declined by 4% due to factors such as auspicious days, weddings shifting to Q2, the elections and consequently the dry days, and impacted corporate and leisure travel due to the summer. While operating income is down 2% for Q1, EBITDA remains flat on a year-on-year basis. Despite these headwinds, the St. Regis has shown resilience with a 36% revenue growth in July 24 versus July 23. Courtyard by Marriott Agra faced similar challenges during the quarter. Occupancy dropped to 63% and the average room rate fell to 4,166. This asset generated 9 crore in total income with a 1 crore EBITDA, resulting in a 15% margin. As mentioned earlier, the heat wave, elections and F&B restrictions impacted the hotel's performance. Slides 23 to 24 cover residential. During the quarter, gross sales reached approximately 50 crore with collections totaling 60 crore. We achieved an average selling price of approximately 20 1,000 rupees per square foot. Our current completed and ready to sell inventory stands at approximately 0.44 million square feet. This brings me to the end of our operational and financial updates across verticals. I will now request our CFO, Mr. Kailash Gupta, to take you through the overall financial results. Thank you.
Thank you, Shishir. Good afternoon, everyone. I will now take you through the financial updates covered from slide 25 to 34. So, between slide 26 to 28, starting off with the P&L updates. On a standalone basis, P&L houses, business of Palladium Mumbai and office which is called the Phoenix House. The income from operation for Q1 FY25 is 118 crore, which is sluggish for the quarter as compared to Y-on-Y quarter, and EBITDA saw a degrowth of 6%. The consolidated basis income from operation for Q1 FY25 is higher by almost 12% compared to Q1 FY24. Our operating EBITDA for the Q1 FY25 we have reported rupees 531 crore with an increase of 8% Y-on-Y. Profit after tax after adjustment of minority interest and exceptional item is at rupees 295 crore for Q1 FY25 grew by over 10% Y-on-Y. Come to slide 28, which is adjusted for the raising business. Revenue across the annuity portfolio was 872 crore, a growth of 24% Y-on-Y. EBITDA excluding raising business grew by 21% Y-on-Y, reaching to 525 crore in Q1 FY25. Retail side, EBITDA delivered a strong performance with a 31% Y-on-Y growth on an asset level. Key drivers including the performance of PMC Mumbai and Phoenix Palladium, along with the ramp up of our new mall portfolio. On a commercial portfolio, EBITDA grew by approximately 33% Y-on-Y on an asset level, driven by improved occupancy, especially at AGH and Fountain Towers. On a local side, Q1 FY25 was a challenging quarter for our business due to a combination of factors including elections, FMC restrictions, and heat waves. Despite these headwinds, and this has shown resilience with a 36% revenue growth in July 25, vis-a-vis July 23. On the resi portfolio, last year we sold a significant amount of ready inventory of our resi assets in Bangalore, which boosted revenue and profits. Revenue was also boosted due to the OC we have received for Tower 7. Given that we now have limited resi inventory, around 0.44, so around 4 lakhs square feet left at Bangalore, we expect annual sales of inventory to be in the range of around 350 to 400 crore. We continue to see strong demand for the completed inventory despite undertaking a price increase to 26,000 per square feet. The sales momentum should pick up in FY26 onwards with the launch of new inventory at Kolkata or Tower 8 and 9 at Bangalore. Coming to slide 29 to 32. Now on our debt and liquidity updates, covering slide 29 to 32. Consolidated debt as on 30th June is 4,398 crore with an average cost of around 8.79%. On a consolidated cash flow front, we generated net cash flow from operations of rupees 514 crore net of taxes. Just for perspective, after removing interest paid to, on the debt side, our operating free cash flow net of taxes and interest is rupees 429 crore for Q1 FY25, which is lower by 5% YoY. However, operating cash flow from our annuity portfolio was rupees 409 crore, up by 20% over the last year same quarter. Group level liquidity improved to rupees 2,343 crore as on June 24, whereas gross debt saw a marginal increase of rupees 31 crore. Our group level net debt position stood at 2,054 crore, and majority of our capex has been funded through the internal approvals and the equity infusion during this quarter. On slide 33, we have a clear roadmap of where we intend to be by 2027. We aim to have an operational portfolio of 14 million square feet of retail, 7 million square feet of commercial offices, close to 1,000 keys in hospitality, and adding 1 million square feet to our AC portfolio. We are now busy charting our growth beyond 2027 and have added our development mix through land acquisition in Thane and Bangalore. We continue to evaluate and work on opportunities to add to our growing portfolio. Last but not the least, the board has recommended our bonus share issuance in the ratio of 1:1, and the same is subject to shareholder approval. This brings me to the end of our financial performance updates. Now the forum is open for Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touch-tone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Puneet from HSBC. Please go ahead.
Yeah, thank you so much, and congrats on a nice ramp up of your new malls. So my first question is with respect to the new mall Bangalore itself. It is already generating within its third quarter some 48 crores of rentals versus your existing Bangalore mall, which is generating 50 crores. So on a quarterly basis, does it look like we've already hit the peak here, because it's still 70% occupied, right? And how much more do you think it can go in terms of rentals from here?
Hi, Puneet. Thank you for your question. On that side, your observation on Mall of Asia is very correct. I think we've seen a fantastic ramp up in this asset, and that is also reflected in the quarterly consumption that we are seeing. And the asset is still at 22% occupancy. So over the next 6 to 9 months, we should see going up to about 90%, and that should really help us establish a new benchmark as far as consumption at our new malls are concerned. The rent should also continue going up in line with, and maybe not for FY25, but if I were to say for FY26, we should see this asset nearing the rentals that we are currently generated at Phoenix Market City, Bangalore. I would also, draw a reference back to some comments from Shishir's remarks as well, wherein Shishir spoke about the retail category upgrade, premiumization, and asset enhancements that we are also carrying out at some of our existing properties. We've already seen the benefits of this shown in Phoenix Market City program, and a lot of these changes are currently underway in Phoenix Market City, Bangalore, and Pune as well. So Phoenix Market City, Bangalore should also step up from the current rent that we are seeing, the current rental run rate that we are seeing right now.
Okay. So do you think that benefit will come in this year itself, or is it likely to be FY26?
Hi, Puneet, Shishir here.
Yeah, Shishir.
So, yeah, these are some interesting ideas, and they will take time to execute in an operating model. So we expect them to start coming in FY26. 26 towards the end of 26 and early 27.
Understood. And the similar context, Citadel, which is still quite young, hasn't grown in this quarter. Anything to read there?
Can you repeat your question, please?
Citadel Mall in Indore, which is still quite young, that hasn't grown in this quarter. I would have thought it would have had a similar trajectory.
Hi, Puneet. So I think Citadel has ramped up quite nicely as far as occupancy is concerned, and the visitors are also, I would say, doing well. Compared to the existing malls, compared to the existing assets, Phoenix Citadel is, let me put it that the category mix is quite good for the 30%. The asset is also constructed at a lower cost, and that is also reflected in the rentals that we see in the asset that we are generating in there. In fact, if you look at the financial metrics in terms of the return that we are generating on the cost that we have invested in this asset, we are ranging within our benchmark guidance of 12 to 15%. We are in fact at the higher end of the guidance. So from that perspective, it may not be accurate to benchmark Indore against a mall of Asia, mall of America. To your specific question on consumption growth vis-a-vis last year,
and rental also, it's flat Y-on-Y, which is why the question is.
To your specific question of consumption growth compared to previous year, there are some, infrastructure improvements that are being undertaken by the government in that area, which has, impacted the traffic flow, etc. And this quarter also has the election results, so we don't do a lot of marketing and promotion activity, but you should see that developing in the coming quarter. Shishir, any comments from your side?
Yeah, it's actually the bridge that's being constructed on the highway right in front of the mall, which has made the access a little difficult. Really impacted our footfalls, and I think it's another 6 months or 8 months of work where we should get completed. In the meanwhile, of course, we continue to look at various initiatives from our end in terms of getting more a better or a different brand mix, more marketing events to drive the current profile of people. So that's an ongoing business for us, which we continue to do. We remain confident about Phoenix Citadel Indore becoming the destination for MP, and I think it's just a blip for a short while.
Understood. And on the big picture for your growth, is there anything that you need to do that brings back the consumption growth back in second quarter, or you think second quarter could still at the margin be similar to first quarter in terms of the mature malls?
For me, for some reason, we are not being able to hear you very clearly. May I request you to repeat that again?
Yeah, sure. My question is, should the consumption growth in 1Q was a little weak for the mature malls. Is there anything which is changing which should drive better growth in Q2?
So you are saying for the stabilized malls?
Yeah, for the stabilized mall, yes.
Okay. Again, I would say, for me, there are a lot of activities and initiatives that we continue to undertake on an ongoing basis. And clearly, these take some time to have impact. I don't think there's a structural consumption issue or a reduction in demand as such that we are seeing. These are isolated situations in this quarter where we may have seen this impact, and mostly in the April and May quarter.
Okay.
So we are seeing the ramp up in May and June better than April was quite impacted. In May and June, we're seeing it ramp up and move forward.
Understood. And lastly, your residential business, One Bangalore West has now very little inventory. Is there a plan to launch the next phase there?
Not as of right now. We are still waiting to understand the development potential, and the TDR, etc. Because the last phase will be dependent on that.
Okay, understood. That's all from myself. I'll come back in the queue. Thank you so much, and all the best.
Thank you very much. Ladies and gentlemen, we will wait for a moment while the question queue assembles. A reminder to all participants, you may press star and 1 to ask a question. The next question is from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Yeah, hi, Shishir. Shishir, my question is more on the matured malls. So the trend on decline in consumption, so it has been there for now almost 2-3 quarters. I know this quarter there could be some exigency which you highlighted. So a large part of growth, what we understand if we normalize them, our consumption is coming from trading occupancy ramp up, and same store sales growth doesn't seem to be happening, barely below inflation. So do you think what could be, I mean, you said that there are no structural reasons, but what would justify this? I mean, because this is not a trend which is there in this quarter, that's been there for the last 2-3 quarters actually.
Hi, thank you for your question. I think the answer lies in for each location, firstly on the question around consumption growth. Let me explain. Phoenix Palladium, Mumbai is currently seeing a massive disruption. We are adding 250,000 square feet of retail space in the next few months, which is bang opposite PVR. As a consequence of that, parking, circulation, all of that has gotten disrupted. This will hopefully settle down during this quarter or early next quarter. So I think that has certainly impacted our consumption, but that was something that we had anticipated and expected a disruption because the gains out of this product enhancement are far superior. So, in fact, if you look at it, Q1 FY25, we may have seen a 4% growth in rental at Phoenix Palladium, and while consumption may be down by 2% compared to last year. But this is a catch-up for the previous growth cycle of consumption where rental is now caught up. Doesn't mean that the occupancy cost is going up significantly or anything like that. We've seen 3% rental growth in Bangalore versus 4%.
Sorry to interrupt, sir. The management line is being a little muffled. Can you please come a little closer to the device?
In Phoenix Market City, Bangalore, we've seen a 3% growth despite a 4% decline in consumption this quarter. Right? I think this is just where we are going to start seeing the ramp up again in the coming quarters. We all know what the disruption was, and in some locations like in Indore, Mumbai, where there is infrastructure work or expansion going on, there is some disruption.
Hello. Your voice is actually a little bit feeble, so when it has been throughout the call, so it's difficult to catch up. So, but I understood you said Indore and this infra work is going on. So I think you have anything else to add, or shall I move to the next question?
I'll just cite 2 more examples. Phoenix Market City, Mumbai, we've seen a 12% consumption growth. And this is a result of all the activities and initiatives we had undertaken in the last several months, plus the opening of, the access from BKC. Phoenix Palacio, Lucknow has seen a 14% growth in consumption and a 12% growth in rental. I think it's just a little cyclical. All malls go through this disruption at some point in time, and it's not related to demand.
So you remain confident on consumption, so just saying that these are more infrastructure or internal issues which is causing this consumption. So there's no such pattern or change in consumption to some other sectors besides the malls.
No, we don't see it that way.
Okay. So my second question is on your plans to add new malls, I think, beyond Surat. So anything else in the pipeline? You've been highlighting locations, you've been evaluating these. So anything concrete and something in the near term which may get finalized in this financial year?
Yeah, I think in this financial year we'll be able to announce one more. We are on the verge of concluding one transaction in South India, and that will be another sizable destination for, it's not just a city consumption center, but a district consumption center.
This one is not in Karnataka, right? I mean, South, when you talk about South, so this, is it? So I think in Hyderabad you were looking something, so is it?
We'll be happy to announce it as soon as we can.
Okay, sure. And this will be like a large layout? I mean, what kind of like mixed-use development? You're looking at only mall or office or resi, so it will have all the potential, or like what?
For the moment, it's going to be, the focus is going to be phase one mall, but a large mall.
Okay, large mall. So large means like you're looking at
Million plus.
Huh? Million plus. Okay. And just my last question is on so residential business. So you have, so what are the launch pipelines or anything you've firmed up on Thane? What's the update on Kolkata? So I think you mentioned about Bangalore. So, but what about this update on Kolkata, and any plans on what could be the mix on the Thane land? At what stage of planning or design is that, and what kind of mix will be there?
Thane, we are not yet ready to announce the development because we are going through various iterations on the return profiles on different asset classes. So we're not ready to announce the development for Thane as yet. In Kolkata, yeah, we are gearing up for launch. I think a couple of quarters and we'll be ready. Design is progressing well.
But as a business on resi, so what could be your pre-sales? I mean, what kind of pre-sales number you have in like 3 years where you've given the plan for next 2-3 years? So how do you think resi business will contribute, and how will it grow, given that beyond this you don't have any major pipeline on residential side?
I think we've always maintained that for us, resi is opportunistic, focusing on building millions of square feet of resi. This was a fantastic opportunity in Calcutta. We saw a mature market with very good benchmark pricing. And we have the skill sets in our resi team to build a couple of million every year. So we're not, even now, we're not going aggressive on this. We will continue to remain opportunistic in the right market.
Okay. Sure. Thanks, Ashar.
Yes.
Thank you very much. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 2 per participant. The next question is from the line of Parvez Qazi from Nuvama Group. Please go ahead.
Hi, good afternoon, and thanks for taking my question. So couple of questions. First, I'm sorry if you had answered this already, but just want to check any update on the new Bangalore land that we had purchased last quarter. Have we finalized our plans there, or what's our thought process regarding that?
Yes, that Bangalore land, it's right adjacent and shares the boundary with our existing Phoenix Market City, Bangalore. We are looking at different options over there. We are also looking at the possibility of whether one can amalgamate the 2 land parcels and expand the development, or we should look at it separately. So this is an ongoing activity at our end. We are working at it. We don't have any specific mix to announce as yet.
Sure. And regarding the resi project in Bangalore, any chance of a new tower launch, let's say maybe in FY26?
I answered that a short while ago. We are waiting for clarity on the TBR policy, pricing, etc. before we one Bangalore West.
Sure. And lastly, just a bookkeeping question. What would be the pending capex on our under construction assets?
Is that question on a first clarification you're asking, or you're asking for the overall pending capex?
Overall would be fine.
Okay. So I think overall, if we look at up to June 2024, I mean during the quarter one FY25, we spent about 470 crores on pure construction and capex for the asset, and balance amount that we have to spend is at about 4,500 crores. And keeping the residential project in a report out of the scope, because that project is typically funded through states of residential units, super state. So we are also keeping Thane out of this. So these are all, I would say, the way to correlate this number is to refer to our slide on what asset mix should be operational by the end of 2027, and the balance capex of 4,500 crores corresponds to that figure. As we announce Thane or as we announce expansion plans in Bangalore, we will update and come back with a revised number.
Sure. Thanks and all the best for future.
Thank you very much. The next question is from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Yeah, thank you for the opportunity. First question is on, the category-wise consumption mix that you have given in slide 10. Certain categories like jewelry, gourmet and hypermarket doing well. It's, because of the mix change that you would have done in, your existing malls, or something to do with that category itself doing well. And the second question to that is, will there always be this, differential of performance between the categories, like, certain categories not doing well or doing below average kind of a growth and certain categories doing well, or you see that there is certain, structural issues that are there with certain categories like electronics, obviously multiplexes, we know what kind of, issues that they are going through right now. But can these categories which have underperformed, now start to ramp up in terms of like-for-like consumption growth?
Right, well, that's right. Let me take this question and address it in different aspects. So first, addressing the gourmet and hypermarket piece. I think in FY23, we have seen this category underperform significantly, and we have seen if we were getting, say, 100 rupees in consumption in FY23 has come down to a very low base of, say, only 50 rupees. From then to now, we have seen new players enter this category, and we have seen a performance improving, but it is still on a low base. I don't think we are back to the pre-COVID number in gourmet and hypermarket. And as we have highlighted in the past, as the catchment around our malls densifies and we see more high-end residential and grade A offices coming in, you need to optimize the spaces given to some categories like gourmet and hypermarket. So there is a rationalization of the space that's given to them, but they continue to remain an important part of the product mix that we are providing at the mall. And after the right sizing and replacement of older retailers by the newer side, I think this category is showing a sustained continued improvement quarter after quarter. On jewelry, I think in the past we have spoken about creating a wedding cluster, which is, according to us, it's defined by having representation from the gold jewelry segment, the diamond jewelry segment, the daily wear segment, and then the Indian and the foreign designers. I think that this entire wedding cluster is taking shape. It's I would say, more advanced in certain malls, but it's also taking a good amount of shape in existing malls, including in Phoenix Market City, Mumbai. And that's why, on a like-to-like basis, we continue to see a good, strong growth quarter after quarter. Structurally, on to your larger question on the underlying trend, I think structurally, Indian retail story remains very promising and very exciting, especially in the cities that we are in or the cities that we are targeting. And one way to look at it is to look at all the number of foreign brands that are entering into India or the expansion plans of the domestic brands themselves. With so much new retailers coming to the market and demand for space, we also, as regional consumption centers, we also need to take some time to reorient the pattern, and redesign the mall for new age consumption. Structurally, we continue to remain very strong and very positive on the consumption story. I hope that addresses your question.
Yeah, it does. Second on the office side, so, if you can provide an update on leasing status at all of, Asia Towers and even for Pune, what's the status in terms of completion, and have you started, any leasing on that front?
Asia Towers, the tower is completed. We are just awaiting the occupation certificate, and we have done about 4 transactions which are right now in government stage, and we have leasing interest for the entire asset to multiple tenants. And I think once the occupation certificate is received, we will start signing those agreements and including updates as well on a quarterly basis from our side. For Pune, on top of Phoenix Mall of the Millennium, we have 3 office towers which will aggregate to a leasable area of about 1.2 to 1.4 million square feet. One tower is fully completed. We have completed the structure and the facade, and we are right now doing work on the internal finishing of that structure. The other 2 towers, the RCC structure is getting completed, and we will move on to completion of the facade. Within the next 9 to 12 months, all 3 towers will be completed, and as we receive occupation certificate, we will start closing the agreements with the tenants and providing an update on our quarterly results as well.
Sure. And just one last on, Surat. So what kind of, rental assumptions that we have built in when we underwrite it? If you can help on that. Surat Mall.
Surat, we have just, completed the excavation in Surat. So construction activities will be commenced now. I would say that we are still a bit early in the sense that we are still 3 years away from completion. But just as a guidance, you can consider about 140 rupees or thereabouts as the starting rentals for the city for the mall in Surat.
Okay, perfect. Thank you. That's it from my side. All the best.
Thank you very much. The next question is from the line of Puneet from HSBC. Please go ahead.
Thanks once again. If you can also, comment a bit on how soon should we see, the leasing of the big Pune and Bangalore office to start generating rent?
Puneet, can you repeat your question again?
How soon can your transactions that you're undertaking in terms of office leasing in Pune and Bangalore can conclude, and when should we start rentals coming from those offices?
So, Puneet, we are expecting our OC in Bangalore.
Okay.
It can be 45 days, it can be 60 days. That's a little out of our control. But I would think that rental generation, one can expect that from January, we should start seeing rental income in Phoenix Asia Towers, Bangalore. We've done some 4 transactions, and we are now working actively on marketing that asset. So we'll start seeing some income from January next year. But I would think that FY26 is the year. By end of FY26 is the year when one can estimate to be close to that 80-85% or 90% occupancy.
Okay. And for the Pune asset?
So this year, but we will not start generating rent. We'll be concluding deals. We'll start generating rent in the next financial year.
Next financial. So Bangalore would be earlier than Pune?
Yes, because Bangalore is ready. The entire 800,000 square feet tower is completed. Both the buildings are completed.
Okay. And any reason why they've been pushed out a bit? Because the mall got completed early.
But we were continuing with the construction and installation of all equipment, machinery, and all for the office. That's the way we always build our composite structures. We launch the mall, we get part occupation for the mall. We continue to build on top.
Okay. Fair enough. Thank you so much. That's all from my side.
Thank you.
Thank you very much. Before we take the next question, a reminder to all the participants that you may press star and 1 to ask a question. The next question is from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
So thanks for taking my question. Just one question. You spoke about palladium and the impact on consumption because of all the renovation work you're seeing. Can you highlight what is the exact square feet directly and indirectly that has been impacted because of this? Because when I look at your mall GL in your presentation, there you are assuming that it's basically the same, GL that's available. So what exactly do you think would be the impact in terms of square feet, both directly and indirectly because of parking, etc., not being available?
Pulkit, we've not shut down any of our operational GLA for this. It's only the parking infrastructure and the ramps, which are also being used for construction, that we are seeing some disruption in traffic movement. And that is discouraging, I think, individuals from coming in and impacting the footfall, impacting the consumption.
Sure. No, I'm also asking about the lifestyle renewal, which is under renovation, etc. So what exactly is that area?
So that, where the lifestyle structure was, that area was roughly around, I think, 50,000 square feet of GLA. But we shut that more than a year ago. So it was not operational in the last, it was operational only for April in financial year 23. FY24, sorry.
Yeah. And there's nothing incremental other than that we are talking about?
Nothing incremental other than that.
Okay.
And of course, we're going to reconstruct a part of the structure and add back some of the GLA. But we are making this a very, very prominent and exciting arrival experience for the massive construction that we're doing with the Project Rise Tower.
Got it. Thank you.
Thank you very much. Ladies and gentlemen, that was the last question for today's call. On behalf of the management of Phoenix Mills Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.